Hi everyone, Darcy Da Silva with nasilvawealth, and today we're going to walk through the four main things that we look at when crunching the numbers or evaluating properties that we're interested in. And so we're going to get a little bit number heavy here. I apologize for that, but we're going to walk through a hypothetical scenario to see how these numbers break down. And so let's say there's a property we see on the market that we're interested in for $400,000. In order to buy this property as an income property, the minimum down payment requirement is 20%. Which would be $80,000, and then you've got another $7,000 for the closing costs. And so our investment to get this property would be $87,000. And now we need to calculate our return on this investment, our ROI. And so we start by looking at the cash flow on this property. When all the expenses are paid, whatever money is left, and hopefully there is some, I'm not in the business of acquiring non-cash flowing properties, whatever's left there would be your cash flow. But you want to make sure you're calculating a few things. So obviously you're taking a look at your insurance, your property tax, maybe property management, utilities, but also a few other things that you don't want to overlook would be including the vacancy rate, which you can look up on Google for your local area and use that as an expense line against your monthly rent, as well as the repair and maintenance of that property. And so we'll use 5% on the monthly rental income that we collect and use that as an expense line there just to save it for a rainy day. You never know what's going to happen. Even if it's a property that's in really good condition, there are going to be things that pop up and you want to make sure you're accounting for that. And so at the end of the year, when all the expenses are paid, you've got your net operating income. And for this property, let's say it's $5,000 that we have left over at the end of the year. The next piece we want to calculate is the principal recapture. We've got 12 months of mortgage payments being made by the tenants. And so the principal recapture for this property would be about $8,000. The interest would be going to the bank, principal recapture would be going to you, everybody's happy. And then we look at the passive appreciation. And so over the course of the next 12 months, we use a 3% assumption. This property is going to increase in value by 3%. And so for a $400,000 property, that would be $12,000. And then finally, active appreciation. This would be increasing the value of the property through renovations or any sort of upgrades. But let's say this property is turnkey, we don't need to put anything into it, and so our active appreciation number is actually going to be zero. And so we look at it, the original investment is $87,000. Then we've got $5,000 from the cash flow, we've got $8,000 from the principal recapture, and then we've got another $12,000 from the passive appreciation. And so that's $25,000. In order to calculate our ROI, we simply take the $25,000, divide it by our original investment of $87,000, and that gives our first year return on investment, which is 29%. And for me, that's a pretty awesome number. And so anything 25% or higher, I'm definitely interested in. And that's really how we break down and evaluate any of the properties we see on the market. Thanks for joining us today, and we look forward to giving you more content as we go.